So just minutes away then from the start of the European equity trading day. We've spent a lot of time talking about being excited about the Asia tech trade. Does that excite you looking ahead, or is it all about US stocks once again?
I mean, I think it's all of those things combined, but the number one thing I'm looking at for 2026 in the equity outlook is growth. Now, I find it really interesting that if you think about consensus estimates for this year, it's for 9%, which on the surface is quite good. It's in line with the historic average, but I think it's actually relatively cautious when you think about the growth context for equities. So what you tend to see is that there's this wide dispersion within returns in the equity market, where if growth is strong, you get very positive returns. So the average positive year is actually up 17%. So last year was actually in line with that. It wasn't totally off-piste in terms of being strong, whereas in years where growth is negative or recessionary, you have negative returns. So if you expect growth to hold up this year, which I think most people do, we have monetary ease that's still feeding into the pipeline in terms of growth. You have fiscal ease as well in terms of expansionary policy out of the US, then you should expect returns to be higher than 10%, which happens 60% of the time. So you should have a more kind of bullish bias than I think what consensus has.
If I'm a European investor, if I was a European investor last year, the dollar killed my performance in the States. Similar story this year?
I don't think it's quite the same. I think also the relationship between equity markets and FX shifts, right? So it depends on what is your cost, what is your output. I think particularly for the dollar this year, you're not thinking so much about downside as we were last year. And again, returning to consensus numbers, what's interesting is consensus is expecting dollar downside versus the euro again this year. Consensus has expected dollar downside versus the euro for the past 9 years. And it's only happened less than 50% of the time.
Bit of catch-up being played maybe then.
Yeah, I mean, a bit of catch-up being played there. I think, too, as we look into this year, particularly at the beginning of the year, positioning has shifted very long the euro. So at the end of 2025, you had asset managers as well as leverage funds being quite long, and particularly leverage funds. That net long is comparable to the level that we had in 2018. That's the last time we'd been this high. And that peak in positioning was also the peak that you saw in the euro traded weighted index, which then traded down for 2 years in fits and starts through the latter half of Trump's term. So that's a worrying comparison as we start the year, particularly if you're bullish the euro as consensus is.
Euro's vulnerable, and you're looking potentially at a 2-year horizon for euro weakness, or more modest?
I think considerably over the next year or so, you can definitely think about euro downside. I think it's partly a catch-up trade. I think it's partly, how much more bullishness can you really price into the euro relative to growth, relative to central bank expectations, but also there wasn't a big reason for dollar downside last year other than hedging ratios rising, and those have now normalized. So that's something to consider both near-term and long-term.
Okay, fantastic. Bloomberg MLIV's Skylar, Montgomery, Koning.